Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to discuss a tutorial on dividend discount model. It is going to be a beginner's guide. Now first, what is dividend discount model? See, it is a way of valuing a company based on the theory that a stock is worth discounted sum of all the future dividend payments. In other words, it is used to evaluate the stock based on the net present value of all the future dividends. See, financial theory states that the value of the stock is the worth of all the future cash flows expected to be generated by the firm, discounted by an appropriate risk adjusted rate. So we can use dividend as a measure of the cash flow return to the shareholder. I'll give you some examples of regular dividend paying company like McDonald's, Procter & Gamble, Kimberly-Clark, PepsiCo, 3M, Coca-Cola, Johnson & Johnson, AT&T, Walmart, and so on and so forth. We can use the dividend discount model to value this company, and let's see that. As you can see over here, we have a graph being colored, different color having different companies' name. Okay, blue one is T dividend, McDonald's for orange, and so on and so forth. So basically it's a dividend yield. What is dividend yield? It's a percentage. How do you find a percentage? So it's dividend per share divided by the price per share. See, anything when you divide by price per share becomes your percentage. So it is your dividend per share. So this is your dividend yield of all the companies that I have mentioned over here in the graph. See, this tutorial is going to be an in-depth tutorial on dividend discount model, and it covers so many other concepts. So let's get into it in by one. We'll be going a step-by-step concept. Dividend discount model first is the foundation that we are going to understand. See, intrinsic value of the stock is the present value of all the future cash flows that is generated by the stock. For example, if you buy a stock and never intend to sell the stock, like infinite time period, what is the future cash flow that you will receive from the stock dividend, right? Let's see in the Excel, and I'll show you some formula for the same. See, the intrinsic value, that is IV, is equal to, for if you hold the stock till your lifetime, till infinity, then your answer is going to be all the cash flow that you receive divide by, you say, 1 plus the discount rate, which is known as K, or your weighted average cost of capital, and you do raised to T. So I'm just writing small t over here, and you do raised to T. So that gives you your intrinsic value. See here, the CF, the dividend. The cash flow is the dividend. So dividend discount model prices a stock by adding all its future cash flows discounted by the required rate of return that an investor demands for the risk of owning the stock. However, this situation is a bit theoretical, as investors normally invest in stocks for dividend as well for capital appreciations. So capital appreciation is when you sell the stock at a very higher price than you buy for. So in such a case, there are two cash flows. First, there is future dividend payments, and second, future selling price. So find the present value of this cash flows and add them together. So what do you get? So you get, as you write, IV, that is intrinsic value, is equal to sum of all the present value of dividends, and you add something called present value of stock sale price. When you do this, you get an IV. It is going to be the stock sale price. Now, the dividend discount model, DDM price, is an intrinsic value of the stock. If the dividend stock pays no dividend, then the expected future cash flow will be the sale price of the stock. So let us take an example and how to deal with this. Let's get into this into deep. Okay, assume that you are considering for the purchase of a stock which will pay you, let's say it will pay you dividend. Let's say it will pay you a dividend of, let's say, $20. Okay, dividend for the dividend 1 next year. And let's say this is for the year 0. Now for the year 1, there will be growth in the dividend. Let's say it will pay you 21.6 for the following year. So after receiving the second dividend, you plan on selling the stock for, let's say $333.3. So what is the intrinsic value of the stock if your required return is 15%? So the first step is going to, you find the present value. That is, you will divide 20 divide by the 1 plus K, that is 15% is our discount rate in this particular case. So I'll show you the whole calculation. How does it work? First, you find the intrinsic value of 20, that is the dividend for the first year, then the dividend for the second year, and in this example they come out to be around 17.4 and 16.3 for first and second year. So let's see the calculation how it goes. So as you can see, the step 1, 20 divided by 1.15 raised to 1, because that's year 1. Second is present value for year 2, 20 divided by 1.15 raised to 2. So in this example, they come out to be close enough to 17.4 and 16.3. The step 2 is to find the present value of the future selling price. That's what we have learned. So 333.33.3 is your price divided by the 1 plus k, that is your WAC raised to 2, because at the end of the second year you're going to sell it off, so you are going to receive the price. So step 3 is going to add the present value of all the dividends and the present value of the selling price. Okay, once you add both of these things, what you get is the final answer. So our final answer is going to be 17.4, 16.3, and the final answer is going to be 255. Let's say 285.8. So let's see this in Excel how it has been worked out. So the dividend payment has been given as 20 in the year 1, okay, which makes us in year 2 there is an increase rise in the dividend by 21.6. we use the present value discounted at 15%, so we get 17.4 and 16.3. the stock price is 333.3, so we just have calculate the details over here and we get intrinsic value as 17.4, 268.8. the total intrinsic value comes to 285.8. I hope you have got it. Now let's get into some of the types of dividend discount model. Now that we have understood that the very foundation of the dividend discount model, let us move forward and learn about the 3 types of dividend discount model. First, it is called as zero growth dividend discount model. This model assumes that all the dividends that are paid by the stock remains 1 and same forever until infinite. Second, constant growth dividend discount model. This dividend discount model assumes that the dividend grows at fixed percentage annually, so they are not variable and are constant throughout. The third is called variable growth dividend discount model, or it's known as non-constant growth. So this model may divide the growth into 2 or 3 phases. The first one will be the fast initial phase, then a slower transition phase, and then ultimately ends with a lower rate of infinite rate. So we'll discuss each one of this in a greater detail now. The first one is going to be the zero growth dividend discount model. See, zero growth model assumes that the dividend always stays in the same. There is no growth in the dividend. Therefore, the stock price would be equal to the annual dividends by the required rate of return. So the stock price is going to be what? The stock price is going to be the annual dividend divided by the required rate of return. It's like intrinsic value is going to be dividend divided by just your what we say as the required rate of return, or you can say K. So this is basically the same formula used to calculate the present value of the perpetuity. So you are sending this cash flow to the perpetual level and can be used to price the preferred stock which pays a dividend that is specified percentage of its par value. A stock based on zero growth model can still change in price if required rate changes when the perceived risk change, for instance. Second is zero growth dividend discount model. We'll take an example and we'll try and reach out how things can be worked out in this. If a preferred, let's say for an example, if a preferred shares of a stock pays, let's say dividend of 1.8, okay, per year, and the required rate of return for the stock is, let's say, 8%, okay, the required rate of return is of a K. What is going to be the intrinsic value? So here we use the formula of zero growth model, that is intrinsic value is annual dividends by the discounted rate of return. So it's going to be 1.8 divided by 0.08 because it's your percentage. So your intrinsic value is going to be 22.25. The shortcoming of this model above is that you expected most of the companies to grow over time. Now the second, constant growth rate DDM model is called Gordon's growth model. Okay, he's very famous guy. His theory still works today. The constant growth dividend discount model, the growth or the known as the Gordon's growth model, assumes that dividend grows by a specific percentage each year. So can you value Google, Amazon, Facebook, Twitter using this method? Of course not, as these companies do not give the dividends. More importantly, are growing at much faster rate. See, constant growth models can be used to value companies that are mature, whose dividends increase steadily over years. So let's look at the Walmart's dividend paid in the last 30 years, because Walmart is a mature company and we note that the dividends have steadily increased over the period. The company can be a candidate that can be valued using the Gordon's growth model. Let's see a graph of the same and get into the nitty-gritty. You can see that dividends have been paid on a negative scale. There's a complete drop since 1995 till 2015. There is a severe decline in the payment of dividend, right? So please note that in Gordon's growth model, we do assume that the growth rate in dividend is constant. However, the actual dividend outgo increases each year. So the growth rate in dividend is generally denoted as G. Okay, growth rate is denoted as G and the required rate of denoted as KE. Another important assumption that you should note is the required rate of return, or KE, also remains constant every year. So the constant growth dividend discount model, or DDM, gives us the present value of the infinite stream of dividend that are growing at a very constant rate. Now let's see the Gordon's growth formula as per the his theories. Okay, so he says the value of stock is equal to, he says, as simple as that, D0. That means he says dividend at the beginning of the year, you please add the growth of the current year and divide this by 1 plus KE, or no, it's you just have to do KE, that is the weighted average cost of capital or the cost of equity based on what you are evaluating. You will use less the growth. So he says that the growth should not be bigger than KE. So it becomes D1. This becomes what? D1 divide by what? KE minus G. This is going to remain the same. Okay, I hope you have got it. So where over here, D1 is the value of the dividends to be received next year, D0 is the value of the dividend received this year, G is the growth rate of the dividend, and KE is the discount rate. Okay, now let's get into the example of Gordon's growth model. I'll take the example number 1. Let's say if a stock is paying a dividend of, let's say, 4 per dollar. Okay, and this year this year, and the dividend has been growing close enough to, let's say, 6% every year, okay, annually. Then what will be the intrinsic value of the stock, assuming the required rate of return is going to be 12%? So the value of the stock is going to be D1. What is going to be a D1? D1 is going to be my 4, that is D0, into the growth is 6%, so I'll multiply 1.06. So my next year dividend is going to be how much? D1 is going to be 4.24. Now KE I am already given with 12%, right? And the growth rate is how much? G is given to me as 6%. So once I have all this detail, we can find the intrinsic value of the stock as 4.24. Okay, divide by 4.24, divide by, I'll open the bracket, I'll say 12% minus 6%, and that's it. We have the answer, $70.66. I hope you have got it. Now Gordon's growth model, let's take another example, example number 2. If a stock, let's say, is selling at, let's say, around 315 is the price of the stock, dollar, and the current dividend that has been paid is 20. So this is the price, this is the dividend. I'm just writing D over here. And what might be the market assuming that the growth rate of the dividend for the stock, if the required rate of return, let's say the KE, what they are given as 15%. So you're asking what should be the growth rate? So it's just simple mathematics. In the example, we'll assume that the market price of the share, that is the IV, that is the intrinsic value given to us, is 315. So 315 is already given to us. What we have found over here is already given to us, and we just have to find G. It is as simple as that. 315 is equal to 20 into 1 plus G divided by 0.15 minus G, because we don't have the value of G. So if you solve it, you get the answer as 8.13%. Now third, variable growth method. Okay, that's the third method we are evaluating. That's called multi-stage dividend discount model. See, variable growth rate dividend discount model, or dividend DDM, is much closer to the reality as compared to the other two types of you can say dividend discount model. See, this model solves the problem related to the unsteady dividend by assuming that the company will experience different growth phases. Variable growth rates can take different forms. You can even assume that the growth rates are different for each year. However, the most common form is the one assumes 3 different rates of the growth. First, an initial high rate of growth. Second, a transition to slower growth. And the third, lastly, a sustainable steady rate of growth. See, primarily the constant growth rate model is extended with each phase of growth calculated using the constant growth method, but using different growth rates for the different phases. The present value of each stage is added together to derive the intrinsic value of the stock. This can be applied as follows. Let's see how it is applied. Two-stage dividend discount model. Now this model is designed to value an equity in a firm with 2 stages of growth, an initial period of the higher growth and subsequent period of the stable growth. So 2-stage dividend discount model best suited for the firms paying residual cash and dividends while having moderate growth. For instance, it is more reasonable to assume that a firm growing at 12% in the high growth period will see its growth rate drop to 6% afterwards. My take is that the companies with a higher dividend payout ratio may fit such a model. As we note below that such two companies like Coca-Cola and PepsiCo, both companies continue to pay dividends regularly, and the dividend payout ratio is between 70 to 80%. In addition, these two companies show relatively stable growth rate. Let's see what exactly goes around in the chart. As you can see in the graph, the high dividend payout ratio with stable growth rates details are given for both PepsiCo and Coca-Cola based Coca-Cola company. Here we have a couple of assumptions. See, high growth rate is expected in the first period. This higher growth rate will drop at the end of the first period to a stable growth rate. Third, the dividend payout ratio is consistent with the expected growth rate. Now let's take an example of two-state dividend model example. Let's say a checkmate forecast that its dividend will grow at close enough to, let's say, 20% per year for the next 4 years before settling down at a constant at 8% forever. So for the 4 years it's going to be 20%, and for 8% is going to be the rest of the years. And let's say the dividend currently they are paying is 12. What is going to be the let's say if the expected rate of return is, let's say, 15%, what is the value of the stock now? So the first step is you are going to do is you calculate the dividend for each year till the stable rate is reached. So the first component of the value is the present value of the expected dividend during the high growth period. Based upon the current dividend, which is given 12%, is $12, the expected growth rate is 15. Value of dividend for 1 year, dividend for second year, dividend for third year can be computed for each year in the high growth period. And the stable growth rate is achieved after the 4 years. Hence, we can calculate the dividend profile until 2010. Let's see how it is done. As you can see, for 2016 the dividend was 12, then after for 2017 14.4. so there is a clear, you can see the rise of dividend, continuous rise of the dividend for all the rest of the years. Then there is a growth rate, it is not mentioned for the first year, then it is 20%, 20%, 20%, and last is 8% forever, right? And the terminal value is 383.9. so you'll make the present value of all the cash flows and find the present value of the terminal value, so you get the final sum. The expected return is 15%, as you know the details around. So my first, this was the this included everything actually. See, this step 2 is apply the dividend discount model to calculate the terminal value price at the end of the high growth phase. So we can use dividend discount model at the point in time. Here in this example, the dividend growth is constant for first 4 years and it decreases. So we can calculate the price of the stock should sell for the 4 years, that is the terminal value at the end of the high growth phase, that is 2020. So this can be estimated using the dividend discount growth method. We apply the formula in Excel, and below is, as you can see, is the terminal value at the end till year 20, and here is the calculation for the terminal value. Also I'll show you how it is done. Can you see how the terminal value has been calculated? The dividend is 26.9, that is the last year's dividend. You deduct the KE, that is the F95 is going to be the KE less the growth of the last year, so that will give you a perpetual value. Okay, step 3 is going to be find the present value of all the projected dividends. So present value of the dividend during the high growth period 2017 to 2020 is given, and please note that this in the example required rate of return is going to be close enough to 15%. Let's see how things have been worked out. We just saw the same thing, it's the same thing, we went through this way before. The step 4 is find the present value of the terminal value, and the present value of the terminal value is close enough to 219.5. and the final step, I'll show you the step number 5. See, all dividends, the growth rates is there, the terminal value that we need to calculate, we have the present value of all the cash flows that is given, we have done the present value of the terminal, and once we do that with the help of expected return, we get the final answer. Step 5 is find the fair value, okay, the present value of the projected dividends and the present value of the terminal value. As we already know that the intrinsic value of the stock is the present value of its future cash flow. Since we have calculated the present value of the dividend and present value of the terminal value, the sum of the total of both will reflect in the fair value of the stock. So the fair value is the present value of the projected dividend and present value of the terminal value. As you can see the calculation over here, we can also find out the effect of the changes in the expected rate of return to the fair price of the stock, and we note from this whole calculation, and I'll show you the graph also, that the expected rate of return is extremely sensitive to the required rate of return. Due care has to be taken to calculate the required rate of return. See, required rate of return is professionally calculated using the CAPM model. I'll show you the graph and let's understand that. So in this graph, can you see this? The sensitivity of the expected return. As the expected return is, you can see if it's increasing, the stock price is decreasing. So if it was 10%, it was at 1000. If it goes to 12%, it is significantly dropped like anything, and for 14%, and for 16%, and so on and so forth. You can see the decline. So this is how the sensitivity thing works over here. Now, three-stage dividend discount model. See, one improvement that we can make to make two-stage dividend is to allow the growth rate to change slowly rather than in completely instantly. So the three-stage dividend discount model, or DDM, is given by the first phase. There is one constant growth that is called G1 with no dividend. The second phase, there is a gradual dividend decline to the final level, and the third phase, there is a constant dividend growth, that is G3, that is the growth company opportunities are over. The logic behind we apply to two-stage dividend model can be applied to the three-stage model in a similar fashion. And I'll show you the formula for applying the three-stage model. Let's look into it. Can you see the formula over here? The D0, 1 plus G divided by 1 plus K, D1 divided by 1 plus K raised to T plus Dn plus 1, so it's going to go into infinity to K minus G and 1 plus K raised to N. See, over here the advice would be not to get more fascinated by the formula. Just do one thing, apply the logic, okay, that we used in the two-stage dividend discount model. Only change will be that there will be only one more growth rate in between the high growth phase and the stable phase. For this, the growth rate, you need to find out the respective dividend and its present values. So if you want to find more example on dividend stock, you can refer to dividend aristocrat list. Okay, this list contains 50 stock with dividend paying history of the 25-year plus. Let's look into the advantage of dividend discount model. See, the first is sound logic. The dividend discount model tries to value of the stock based on all the future cash flow profile. Here the future cash flow is nothing but the dividend. In addition, there is very less subjective in the mathematical model. Hence, many analysts show faith in this model. Second, mature business. The regular payments of the dividend does imply that the company has matured and there may not be much volatility associated with the growth rates and earnings. This is important for investors who prefer to invest in stocks that pay regular dividends. Third, consistency. Since dividend in most cases is paid by cash, company tend to keep their dividend payments in sync with the business fundamentals. This implies that the company may not want to manipulate the dividend payment, as they can directly lead to the stock price volatility. Let's look at some of the limitation of dividend discount model. See, for understanding the limitation of dividend discount model, let us take the example of Berkshire Hathaway. Who doesn't know that? CEO Warren Buffett mentions that dividends are almost a last resort for the corporate management, suggesting companies should prefer to reinvest in the business and seek projects to become more efficient, expand territory, extend and improve product lines, or to otherwise widen the economic moat separately in the company from its competitors. See, by holding on to every dollar of the cash possible, Berkshire has been able to reinvest it at a better returns than most of the shareholder would have earned on their own. Okay, Amazon, Google, Biogen are other examples. They don't pay dividends and have given some amazing returns to the shareholders. So can only be used to value the mature companies. See, this model is efficient in valuing companies that are mature and cannot value high growth companies like Facebook, Twitter, Amazon and others. Second, the sensitivity of the assumption. See, as we basically saw earlier, fair price is highly sensitive to the growth rates and required rate of return. 1% change in this too can affect the valuation of the company by as much as 10 to 20%. Third, it may not be related to the earnings. So in theory, dividends should be correlated to the earnings of the company. On the contrary, companies, however, try to maintain a stable dividend payout instead of the variable payout based on the earning. In many cases, companies have even borrowed cash to pay dividend. If you have got the best of the best knowledge, you can refer to the other articles also. Thank you everyone. This was the great knowledge for dividend discount model.